Hi, and welcome to the Stockscores Market Minutes for February 7th, 2014. This week, we're going to take a look at the Sentiment Stockscore, one of the key indicators that you can get at Stockscores.com. When you're thinking about a stock to buy as a position trade or longer, it's important to ask whether investors like the stock you are considering or not. Investors will judge the fundamentals differently if they are optimistic about the company than they would if they are pessimistic about the company. And ultimately, those that are liked, those that the market is optimistic about, have a better chance of going up. The key is to find the stocks that are just starting to be liked, just starting to show those signs of optimism where they're breaking through resistance. Stocks that have a sentiment stock score of more than 60 have optimism. It's a method that I devised to allow a computer to scan through the market to look for stocks that have good potential. So here's an example. This is one of the top performing stocks on the Canadian Stock Exchange last year, Air Canada. And you can see that in the period from August until January last year, when the stock did very well, the sentiment stock score was climbing and moved above 60 in September. You can also see that in December, when the stock didn't perform very well, the sentiment stock score, which is the green line, so the green line on the chart there, fell back below 60. So one of the key things that I always look for is whether that sentiment stock score is above or below 60. And if you're looking for a stock to hold for a longer term trade, something more than a swing trade or a day trade, then always check the sentiment stock score because it really puts the odds in your favor. And you can do that for free. Just pull up the symbol on Stockscores.com. It'll give you the sentiment stock score for any stock that is traded for 200 days or more. All right, let's get into the analysis for this week. So we've had a lot of volatility the last few weeks. Monday was the biggest down day that the market has seen in some time, but it erased most of those losses, well, all of those losses for the week anyway, on Thursday and Friday. So the question then becomes, is this really the start of a correction, or was this just a little blip and we're going to be back into the bullish trend? Well, what's important to understand and recognize is that February 3rd, Monday, we broke the medium-term upward trend line for the market. And that is a sign that the buyers lost control of the market. Now, the last 2 days, we've seen some pretty good strength, but the market has not yet made a new high. And that's really what's critical to watch for. Can the market come all the way back into 184.50 on the S&P 500 ETF, SPY, to make a new high? Or is the market going to make a falling top and then go through another major selling phase? And at this point, I think you have to be pretty cautious about U.S. stocks because that trend line was broken. That's step one in a trend reversal. Step two is the formation of a falling top. And step three is a subsequent second break of the upward trend line. So keep an eye on that. I mean, it feels better with the rally that we saw Thursday and Friday, but I think that the market is far from out of the woods. So keep a very cautious approach to the market. Now, the Canadian market looks quite a bit better, and of course, it hasn't climbed the way the U.S. markets have. We don't have as much potential profit taking that we've had in the U.S. markets. The Canadian market held its upward trend line. I've drawn that in green. This market is in an upward sloping channel, and it seems like money is coming out of some of the high-flying sectors like technology, biotech, that sort of thing, and moving into some of the real lagging sectors like mining and energy. And so there's a sector rotation underway that favors the Canadian market. And so I actually like the potential of the Canadian market better. We're in early stages still of an upward trend because this upward trend has only been underway for a few months, whereas the U.S. market upward trend has been in place for much longer. I think there's great potential in the Canadian market, but again, early stages, so you have to be a little bit more patient with the Canadian stock market. So Treasuries in the U.S., that's an important chart to watch, particularly if you're interest rate sensitive. Perhaps you're looking for a mortgage, that kind of thing. The bond market is what determines mortgage rates. And here we've got a case where bonds rallied pretty nicely in January, a little bit of profit taking in the first few days of February. But you know, generally what we see here is that the bond market, which had been in a downward trend for some time, is bottoming. And that means interest rates are stabilizing and maybe coming down. So that's a positive for consumers and also for the companies looking to finance themselves. Emerging markets has been the sort of scapegoat for much of the weakness in the U.S. stock market. I don't know if it's entirely deserved, but that's what gets blamed. I think the emerging markets are a bit oversold and likely to bounce back, but certainly not a good-looking market. We've got falling tops over the last 4 or 5 months. We've held support, that's good. But aside from perhaps a little bit of a bounce back here, the trend is down. U.S. dollar has been sideways, more or less, for the last 3 months, but the bottoms are rising. And if we can get a breakthrough resistance at the red line on the chart that I've drawn, we could see a bit of a rally in the U.S. dollar. And that is the one thing I'm worried about for the commodity stocks, because, of course, a rally in the U.S. dollar would imply or predict lower commodity prices, like lower prices for gold, oil, and that sort of thing, because those things are priced in U.S. dollars. If the U.S. dollar goes up, it gets more expensive for the world to buy those things. So there's a bit of a flight to quality over the last few weeks because of the emerging markets problem. But this is a chart to watch. It's an important one to keep an eye on. The gold market broke the upward trend line, or pardon me, broke the downward trend line not long ago, and it's slowly building that optimism. We're starting to see money come back to gold, and that is helping the gold miners. We've seen some pretty good trades in the gold mining stocks so far this year. I've made a few features in my newsletter so far this year. I don't want to get too overzealous because this is still, long-term a pretty negative chart, but it is a chart that's trying to reverse. How do we know that? Because the bottoms have been rising over the last 4 or 5 weeks. They broke the downward trend line. That's another positive. The issue with this chart is that it's got lots of resistance to chew through. All the people that bought gold August, September, October, November, and going back even farther have been losing money. So they're going to sell into strength in gold, but at least there's stability, and I think that'll help the gold mining stocks, which are really pretty oversold. The oil market, pretty good day on Friday, been rallying over the last 3 or 4 weeks as it bounced off of support. Not a chart that I think has great upside potential, but again, the stability in oil is helping the energy stocks, and money is flowing out of some of the high-flying sectors and rotating into the energy sector, into the gold mining sector. And so we've seen some pretty good stock trades in those areas. Now, fear has been, I guess, heightened over the last few weeks because of the pullback in the U.S. stock market primarily. We saw that really pull back the last 2 days, but what I like about the VXX, and this is, of course, the way to trade fear, is that there's lots of volatility again. You look into the first couple of weeks of January, and the VXX was an absolutely dead thing. There was no action there, and so we don't want to trade it then. I love trading the VXX. It's very easy to trade when there is volatility. We've had volatility in the VXX the last 2 or 3 weeks. We had it in October. We had a little bit in June. That's the times you want to trade this thing, is when there's action. And there's still action there. It's just a little bit to the downside, but don't take your eyes off the VXX because it is a good trading vehicle. All right, so I am neutral on U.S. stocks. We've got a little bit of a bounce back. We may hold that long-term upward trend, but I'm not too hopeful. I do like how the market has rallied back in the U.S. over the last couple of days, but I think you got to be pretty cautious as well. The Canadian stocks bullish in the daily trend and also in the intraday trend bullish. Gold neutral longer term, but bullish short term. My apology for the spelling mistake there. And neutral on oil in both time frames. Stock markets are coming back from the weakness that started 2014. And since the upward trend line was broken, we have to be very cautious about how we watch for whether the market can achieve a new high or if a falling top will be formed in the next week or two. The Canadian markets are holding in their upward channel thanks to the outperformance of gold mining and oil companies, and I think that's an area that traders should be looking for as that sector rotation is underway. Well, that has been the Stockscores Market Minutes for February 7th, 2014. Have a great week in the market and trade well.